Welcome back to Golden Rule Radio, your weekly recap of the precious metals markets and the markets that are closely associated. And it seems like all markets are tied, but in our opinion, all roads lead to gold. So, guys, where should we start? Because eventually it's all going to come back to the gold conversation.
Yeah, gold had one heck of a day today.
Yeah, the gold road seems to be that interstate. So all roads may be leading to it, but it's definitely moving the quickest. So I think that's a great place to start, guys. Let's start with gold up 8% since our recording last Wednesday, currently at $3,338. That 8 got in the way of the 4.3, but we did have that earlier today, so that made me happy. 3,333. It was a fun price for gold today. Silver, not too shabby, although zoom the chart out, silver remains staggering a little bit behind gold, but had a pretty good week this week, up 5.5%, back up to 32.70, and starting to look a little bit healthier after the big drop off with the other markets last week. Platinum just slightly behind silver at 4.6% up this week, back up to 960. Platinum seems hard stuck between about 950 and 1,000 and continues to remain there. Palladium, the sister metal to platinum, takes a tiny lead here, up 7% this week to $972. So the fist fight between those two continue as they hover right around the 1-to-1 platinum to palladium ratio. And round we go there.
I wish they were 1-to-1 at 2,000 an ounce.
Right?
Instead of just stuck here. Now, giving credit where it's due, the president is trying to initiate an industrial revolution, and that's when we'll see platinum and palladium finally break north of 1,000, when that becomes a reality, because they're such industrial metals. But
right.
Don't get lulled to sleep on them. We're just early, that's all.
Well, and silver, I think, India announced last night in an effort to reduce the trade deficit, a surplus for India. They want to use that surplus and buy gold, silver, and oil from the United States, and that just caused a moonshot for gold in the early morning hours.
Wow. You should send them an email.
Yeah,
tell them to do that through you. Yeah. You got 2/3 of that equation figured out. Yeah, well, Miles, you said attached to the hip. Not a whole lot has changed. The ratio's been as steady as the platinum and palladium ratio in the last few weeks in terms of the gold to silver ratio. I'm talking about, we've fluctuated between 99 and 101 for weeks here, but we're back to 101 today, $100 move in one day in gold.
Yeah.
It's funny, Jeff, who's been on this program before with us a couple weeks ago, I'm like, Jeff, I really feel like we're on the verge of seeing $200 moves in gold in a single day, because we've seen that type of percentage move in silver. Well, here, I didn't think it's going to hit 100. We've now had $200 days in gold, and think about that. That's unfathomable before. Now it's only a few percentage points, which is ho-hum for silver. I've seen 7% moves in silver in a day, but gold doesn't do that. It doesn't have that same volatility. But when it does, there's a real possibility that if the infrastructure is really collapsing in the monetary and fiscal aspects, that you could see some real significant 6+% moves in a day in gold. And think about that, guys. We're talking hundreds of dollars now.
Yeah. Gold shows no sign of slowing down or backing up. It seems the bit is in the teeth, and this is one of those times where gold is just relentless.
Well, we're looking at that gold to silver ratio up over 100 for, to my knowledge, the third time in history.
Yeah.
The last time it took COVID that caused that to happen, as we had the big spike up in March of 2020. But what was interesting and different about that time compared to this time is because of the other situations taking place, the COVID aspect, there March, April, May, you really couldn't do a swap from gold to silver at 120-1 because the premiums on coins, with the mint shutting down and everyone kind of going into lockdown for a while, the premium and availability of product just sort of skyrocketed.
That's an excellent point, Miles. Excellent point.
This is the first time.
It stopped me from doing anything. Yeah, I saw 120-1, but by the time you did the math, I had to take my boots off, to do the math. And I'm looking at it, and the ratio was, a lot lower than 120. I think it was in the low to mid 90s, as I recall.
Because of how expensive silver actually was.
Yeah, physical silver. Yeah.
Good point.
For those of you that need us to translate Rob for you, he had to take his boots off because he ran out of counting fingers.
Right.
So just thought I'd toss that out there for those of you that wondered why he said that.
Thanks,
and then
Miles.
the last time, you're
That was
welcome.
one.
I've been speaking Rob for 20 years, so I'm kind of used to it at this point. And then, of course, the first time that ever happened was, Rob, you were in the markets, I believe, but I was 10. That was 1991. So that was a bit ago. I was 10 years old. Yeah. So I didn't really care what the gold silver ratio was when I was 10. I was watching Saved by the Bell. Yeah. So that was 1991 was the last time that happened. So yeah, it is interesting to me that this is the first time where you really actually can take advantage of
Yes.
the ratio opportunity, because
Yes.
when we were at 125 to 1, either A, the spreads on things like, say, Silver American Eagles were so high that you weren't swapping at 100 to 1, you were swapping at like 90 to 1,
Yeah.
which was crazy. This go around, we've got relatively neutral spread market across the board,
Yep.
from 1,000-ounce bars all the way to Silver Eagles, Silver Maple Leaf. So minus a slight normal market spread of a couple percent, I mean, you've got the opportunity to come into something like silver at the third best opportunity in history.
I would say it's the second best, because I kept waiting for the premiums to settle down during the COVID spike in the silver gold ratio. And by the time the premiums normalized, the ratios fell back to more of a normal range and the opportunity was over. So it really wasn't an opportunity.
Yeah, at 115 to 1, I remember the real entry was closer to 95 to 1, like if you were doing an American Eagle or something of that nature. And yeah, really good point. Here we've got really low premiums,
Yep.
which is really because of soft demand.
Yeah.
And that's going to surprise everybody. But the retail space, David McElvaney said this in an interview last week. We haven't seen the Western investor or the retail investor out West really step into this. We're seeing this continued ramp up in China, in India, the East, like ETF inflow, the Shanghai Gold Exchange numbers are spiking big time and up, 20%. To me, it's like, yeah, that's a lot of demand. We see a lot of demand now starting to pick up in the West through ETF inflows, but we haven't really seen it in the physical market. And what's interesting to me is when that happens, that's when you really see that last phase, is what some people will call melt up. I mean, you talk about a couple $100 move in a day. It's when for some reason there's panic in the U.S. streets and people are scrambling to buy it.
Yeah.
And that's when you'll see the premiums on gold and silver spike, because the supply can't keep up with the demand. Right now, supply all day.
Good supply.
Yep.
Yeah, and really encourage our listeners to take advantage and call their brokers. The brokers here, not anywhere else, only at McElvaney's.
Way to clear that up, Rob.
Yeah, that's right. And it's funny too, because you talk about, maybe there's a ratio trade in your account, which is a reason to call. But I mean, even if you're getting in, like, it's a really critical conversation because you don't want to dead end yourself. You've got to be strategic on how you start a position. If you've never started with precious metals, listen, don't feel like you've missed the boat at all.
No.
I mean, Rob, you heard that at 500,
Yeah.
at 1,000,
Yeah.
at 1,500,
Yes.
right?
Yeah.
Here we are at 3,300. It never matters. Gold just unfortunately goes up in our lifetimes because of the depreciation of the dollar. So unless you feel like somehow something's going to change with the fiat currency world or fiscal policy or monetary printing and monetary policy and geopolitically, guys, none of those fundamentals show any sign of us switching course.
Yeah, no, they don't. And, it's hard, though, because I talk to children of family. They'll be talking to their mom and dad or their uncle or even their children. And people get fixated. I know how much money I have sitting at the bank, and I can see how much the stock market does. And they're so used to the stock market always going up and the dollar remaining viable and stable. It's very hard for them to shift to an asset like gold because it's not in their comfort zone. You have even kids saying to parents or parents saying to kids, well, what good is gold if nobody has any money to buy it with? And they get stuck in this idea that gold is some kind of pet rock. But it's not. It's an allocation, whether it's an allocation as insurance for the rest of your money or an allocation as capital to say, let's shift some of this, take 20 or 30% or even 10 or 15%, shift it to gold and see what happens over the next 4 years as they try to wrangle this 2/3 or 3/4 of the national debt that they have to refinance during this administration. That's a volcano of treasury paper spewing into the financial market, not just in the U.S., but worldwide. Doug Casey, another newsletter writer, was saying it's like trying to drive the water from the big dam out west. What's it called?
Hoover?
Yeah. Doug Casey said it's like trying to drive the water from the Hoover Dam through a garden hose. It's incapable of absorbing and moving that much product. So, yeah, we've got a real situation on our hand. And I am finally hearing and listening and seeing printed the fact that they are trying to refinance $9 trillion in the next couple of months.
Yeah. I don't think the average American knows how to even conceptualize that or grasp the enormity of that.
I don't either.
Right. And as you refinance and it's up at, an additional 1% on average expectation from what the debt service costs us right now on $9 trillion. And people they're numb to the $1 billion figure anymore.
Yeah.
And unfortunately, 20 billion here and, talking about stabilizing Argentina and doing some stuff with 20 billion or 40 billion and people, it's like it's $20. Right. So
it is funny that we've grown numb to the word billion, because you go back to the 80s, 90s, 2000s, we had grown numb to the word million and we were fascinated by the word billion. Now we've grown numb to the word billion and we're fascinated or can't even conceptualize the concept of trillion. So Is quadrillion next? Like, when do we get into the quadrillions where we're just all numb to the concept of trillion? I don't know.
It's being used already, but before we leave this concept, Miles, let's put at that ugly chart of the U.S. dollar.
Oh, it got crushed.
Which is just the inverse of the gold chart. And imagine you can extrapolate this chart out, this image, over the course of decades. If you look at this dollar as, let's assume that it's the purchasing power of the dollar. That's why gold's chart over the last 50 years looks the way it does, because it's the mirror image or the inverse relationship of this U.S. dollar purchasing power. That's not going anywhere. And keep in mind, we just had positive retail sales numbers up 1.4% in March. Doesn't matter. The dollar, there's concern. This is the most negative dollar sentiment in 19 years.
Right. Well, we knew it was coming. We knew the path that we have been on for decades was unsustainable. And here it is. Yeah.
Remember the dollar index, Miles, you may have to extend out. How low did we get post-financial crisis? It was in the 70s. Where are we today? 99?
Yeah.
0.6 or something.
Yeah.
Dollar index, let's see here. Dollar index actually bottomed out in March of 08.
Okay.
71.46.
Makes sense.
Highest spike would have been February, March of 85, 160, just under 165. So we had a big spike through late August of 80, where it started just a little bit lower than we're at now at 84. Spiked all the way up to 165 by 84. I think there might be some little political things that were taking place in the early to mid 80s. The kind of the end of some kind of non-combatant war that the American economic system had been fighting for X number of decades. And
the thing that's getting reignited now? Is that what you're talking about?
The thing that, except they're using drones. The thing.
To quote Joe Biden.
When you're looking at the death of the Cold War, it certainly ends up making the victor at the time, their particular economy, look significantly stronger for at least a period of time. But realistically, if you take that kind of mid-80s spike out, you're talking about, the dollar index ranging from anywhere between about 120 on the top end down to around, let's say, 70 on the low end, 70 or 80 on the low end. So you're talking about an index. This isn't the value of the currency. This is the value of the currency as it relates to other currencies.
I'm glad you brought that out. I was waiting for that. Yeah.
So the farther you get away from 100, the harder it becomes to go farther. It's like a tornado scale. Like an F2 isn't slightly bigger than an F1. It's like 10 times the size.
Yeah, it's
and an F3
exponential.
is 10 times. Yeah, exponential. Thank you. Logarithmic, whatever the correct word is. I don't know. I quit math after high school.
Like the gold-silver ratio.
Well,
Yeah,
I'm ready to take my
exactly.
boots off if you need to do higher math, Miles.
Start
You
keep
just let me
counting
know.
for me now. Yeah, what comes after 10, Rob? Take your shoes off. So we're still talking about a dollar, which had been a dollar index, which had been rising since the end of the last economic crisis, which, the 2000 to 2010 period, post 9/11 to the post '08 market crash. That was kind of an economic period that signaled a decline in the dollar. And then we've had about a 10-year cycle where the dollar had been rising. Now, that 10-year cycle has been capped off. It was pretty easy to get the dollar to rise in value through the time, mainly because of the significant decline that we had the 10 years prior. It's always important to me that people who are looking at economic data, talking bobbleheads on television, like to tell us that the thing that's happened in the last 9 seconds is the most important thing that's ever happened. And it's like, no, you got to take a look at the whole picture here. There are ebbs and flows in markets over time. So let's talk about one of those ebbs and flows real quick that I think is key here. Now, as we got close to what is the legitimate sort of long-term range in the dollar index, let's say from 120 on the top end down to about 80 on the bottom end, is where the dollar index has spent most of the last 50 years. It's spent in that range. As we're getting closer and closer to the top end and the end of this like 10-year strengthening cycle for the currency, well, what happens is we start to see interest rate rises, which had been at all-time lows. We don't need to go into this. We talked about it extensively 5 years ago, 10 years ago, and every single person listening to this got really sick and tired of their savings account paying 0.1%. Like, we all knew the interest rates were low.
And people are even predicting that we were going to go to negative interest rates.
Yep.
If people recall this, where you would have to pay the Treasury to hold your money.
Even had a stupid name for it called NERP.
Yeah. And now, they started raising interest rates. So from the time they started raising interest rates from almost zero, I think the 10-year yield was, I want to say 35 basis points at one point. Does that sound right?
Yeah, I mean, everything almost bottomed. And think about that right now, because you think, well, okay, can the dollar go lower? You guys, if the dollar goes 30% lower, where's the gold price?
Yeah.
Just case in point, look at 2008. Gold went from 700 an ounce to 1,925. That type of price action is a real phenomenon. And if we have the most negative dollar sentiment in 19 years and the most bearish investor sentiment in 30 years, well, then you would think that there's some economic slowdown coming, which means the Fed likely is going to cut rates.
Well,
and
they
they
don't
go
want
hand
to.
in hand. They don't want to because they're political.
Yeah,
know.
they want to blame Trump.
Yep. And that's why you have all these Fed presidents out there doing this
trashing him.
anti-Trump rhetoric, which is clearly in the political realm.
Not
right?
helpful.
Not helpful at all. In fact, it's actually counterproductive. But all that being said, guys, the gold price, where does it go? What if it goes up 30%? Now we're at 4,000, which is what Bloomberg's calling for now.
Bloomberg, 4,000, 4,500, right around there. Goldman Sachs, that's what they're predicting. And we're not even going to stop there.
No. And again, that dollar index will be coinciding or even resulting from rate cuts because of stimulus.
But Miles pointed this out earlier. All the benefit that the dollar had from rising interest rates from near zero to where we are now on the 10-year, I think we've lost all the gain that we've had in the dollar.
Very close to it. Yeah.
Yeah, from a very radical change in interest rates just over the last 10 years.
And that's your dollar index, right? Again, that's the dollar's relationship to other currencies globally.
Exactly.
So obviously, like the 10-year rate, the yield on the 10-year is higher than it was in the spring of 2022, March, April 2022, when we started raising interest rates. But when we started raising interest rates, the dollar index was sitting back around, let's say, 98.5. Today, we're at 99.25. So, and to your point, Tori, we're a 27% drop takes us to the 2008 low in the dollar index. So you're not too far off to think, could the dollar lose another 30%? Yeah, and that wouldn't even take it to its lowest point in history. That would just get us down to about where it is. And I would argue it ain't one for one with gold. The dollar index is off 14% since the peak over the last year or so. Gold's up over 50%.
That's a great
good point.
A 30% drop in the dollar index is going to do a lot more than a 30% rise in the price of gold or any other goods and services, from your eggs, your milk, your oil, your cereal, anything else.
Like 2008 to 11.
Yep,
You're right.
exactly.
I mean, here it dropped down to 71 and gold almost tripled in that period of time.
Well, I am holding out hope in what you just said, though, Miles. I'm going to slightly disagree with you. I do think the administration's policy of driving oil prices down is already being seen at the pump. I do think that's going to affect the price of eggs and the price of groceries. So I'm hopeful that gasoline will get down to around $2 a gallon. Eggs will continue to fall. Farmers are able to put crops out there. Everything runs on oil. If we can make it cheaper, that'll help people put food on the table and gas in the car. But in the meantime, everything else is going to be much higher.
Well, you can't sit there and expect the continued cheapest goods out of China type of phenomenon. And that's the whole thing. This really comes down to that. And the reason that they did this broad-based tariff really was to keep China from circumventing the Chinese tariffs. So they don't have other ports through which to send things. And that's what they did in his first administration. And a lot of people don't understand that. You know, suddenly they're shipping out of Thailand or Bangkok or, somewhere else. And they circumvented the tariffs. And so now there's this checks and balance where that's a necessary broad base, but it's also why they'll have targeted tariffs based on country to country. And it's starting to have a positive result in terms of bringing manufacturing back. And Honda just made promises now.
Yeah. If we can just keep it going.
You're going to make a lot of enemies in the process. You're going to lose a lot of even your voter base. I mean, the oil and gas industry is not happy about these cheaper prices. It doesn't make a lot of sense for them to drill. And he said, drill, baby, drill. And yet it's kind of cost prohibitive to drill at $56 a barrel, so there's a catch-22 here, and we'll see how long things happen. But it gives you a good opportunity to really focus on pipeline infrastructure. But the refiners are going to be struggling. The drilling and exploration companies are going to be struggling for a bit. And that's kind of a core part of his voter base.
Yeah.
Well, yeah. And it's interim struggle, like you were saying, right? Like it takes time to rebuild infrastructure, but it really is one of those things where the longer this goes on, the better it averages out for America. And that's kind of the way I look at it, is if we're going to have a shift of manufacturing base, well, it takes time to get the infrastructure up and running. But the longer this plays out, the more likely you start to see the benefit over time. So it's ripping the Band-Aid off. It always hurts up front. I'll toss one last thing in there just with the way gold's been going up, Rob, because we got to throw it out at least every week or two. Gold managed money caught report down to 180,000 long contracts to 40,000 short. So it is starting to inch back that direction. I think we were
240.
240 to 10. Then we went like 220 to 40 or 210 to 40. Now we're at 180 to 40.
Okay.
So we are starting to see, as the price of gold comes up here, we are starting to see a little bit of the unwinding of the long contracts and a tiny bit addition to the short contracts. It's not surprising. It's perfectly healthy if gold finds an interim top somewhere here within the next couple $100. Who'd you say was it? Goldman Sachs was targeting 3,400.
No, 4,000 north.
4,000.
Bloomberg is 4,000.
Sorry, Bloomberg's targeting 4,000. So there's probably going to be some type of interim high here. So be prepared for that. Just a warning that I've been talking with all my clients about. We have no concern where gold's going to continue to go long term. There are too many irons in the fire right now, especially with the refinancing of debt coming up this summer. But very few things get to go up 60% in 13 months without having some semblance of a pullback. So just be prepared.
Taking. Yeah.
Yep,
It's another reason to buy every month.
Yeah.
You don't worry about it if you just buy every month. And
So
that's
you just
what we
average
practice.
your price out over time.
That's right.
Yeah. So that's pretty much it. Just be aware that as prices continue to rise, the likelihood that they continue to rise starts to diminish over time as they lose momentum. And that's a perfectly healthy thing. And what that does is that sets up for the next move. So that's going to do it this week for Golden Rule Radio. As always, we appreciate you joining us each week. If you liked what you heard, hit the YouTube buttons, but better yet, why not head over to our website to find more information at McIlvaney.com. You can also find us on Twitter at ICA Gold and Facebook at McIlvaney Financial. Better yet, why not give one of the advisors here at McIlvaney Precious Metals a call to discuss your personal precious metals portfolio? You can reach us at 1-800-525-9556. Thanks as always, and have a great week.